And silver's had much of the same. If we look at silver, this past session, there was a big bout, heavy volume selling in silver as well. So again, it's not just gold, people are trimming profits, it's silver as well. You can see on this 10-minute chart down below, a couple days ago, we had a big bout of selling in gold. And then just 2 days later, we saw another big bout of selling with high volumes. Potentially, silver could spike up to about $84, $85 over the next 4 to 6 weeks, potentially. And that would mean gold probably goes to 4,500, potentially even higher. This is just an early warning sign that we're in a volatile market condition for gold.
Gold and silver are entering what could be the most volatile and decisive phase of their bull market. Both metals have surged to levels unseen in over a decade, driven by global uncertainty, institutional buying, and widespread investor FOMO. Yet behind the euphoria, seasoned traders are beginning to trim profits, a signal that markets may be approaching a near-term peak before the next leg higher. Technical patterns show gold consolidating around key Fibonacci levels near $4,100, while silver mirrors its historic 2011 parabolic structure, with potential to spike toward $84 to $85 in the coming weeks. This stage often marks the transition from steady accumulation to emotional, high-volume trading, the feeding frenzy that tests every investor's discipline. ChrisVermeulen, founder of the Technical Traders, emphasizes that this rally phase is both an opportunity and a warning. The fundamentals remain strong, but volatility is back, and savvy investors are already managing risk. As he explains, the current setup rewards strategy over greed. Those locking in gains will survive the inevitable correction that follows the euphoria. The precious metals market is alive again, but the heroes of this cycle will be those who know when to protect, not just when to profit. Now, we present the clips from ChrisVermeulen's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
What do you see in the future for gold, the price of gold?
Yeah. When we take a look at these moves in the market, we had the rally up, we had the big consolidation. If we carry that over to where that price is, there's we're getting to this 4,100 level here, 4160, 4180. Really depends on which bars we pick from, but overall we're looking for 4100. Typically, when gold rallies or when an asset rallies and it hits the 618 level, this is known as the golden ratio, the 618. If it pauses there, generally we go up and we hit the 100% measured move, the one level afterwards. And of course, we have done that. If we drop down to the daily chart and we look at the orange line here, which is the 618, you can see gold has kind of stuttered and kind of got a little stuck there. That is a good thing. That's just telling us the momentum waves going through the market are accurate. You want price to run into a little bit of resistance at the 618, and that means everything is lining up. And once those sellers, whoever was going to naturally get out at that price level when they hit a satisfaction level, once they're done, we're going to see the market rally to the next resistance level, which is about 4,100. So I think we're well on our way. I think potentially we're going to be there in a week or so. So I like gold. I mean, we're long gold. We played this breakout with an extra gold trade to take advantage of this move because this is just gold is in that sweet spot. The whole precious metal space is. The fundamentals are behind it. We've got global chaos, and of course, I think we're also, in a late stage of the stock market, which is where precious metals start to come to favor naturally. So all kinds of things are together. In fact, if we look at even the seasonality chart you and I might have touched on before, really from August, where you and I talked and we got the breakout in gold, all the way till pretty much, where we are now is the sweet spot for gold. Naturally, gold wants to run up into kind of early October. And then from there, it might take a bit of a pause or a breather. So we've definitely had a tailwind. Everything is in favor. And I think gold still wants to push up higher. And it's a nice trade to be in right now. This particular trade, this extra bonus trade we've done in gold, we took some of our profits at the 618 level. So around 3,700, we took some off. I plan to take the rest of this particular trade off when we get to about 4075 or 4100. And again, that's just a simple ETF trade just to get more exposure to this space. I own a lot of physical gold, which I am planning on lightening the load at some point. But I do feel like we're going to see gold, silver really spike up and potentially blast through this 4,100 level. So from a trading standpoint, 4,100 is more or less my next target to trim off the rest of a short-term trade. As a long-term investor of gold, I do think we might see a blow-off phase to the upside. And if we do get a big vertical blow-off in gold and silver, I may actually trim some physical metals as well. But got to wait to see if and how that unfolds if I'm going to do that. But you were mentioning some people were taking some profits. If we look at the 10-minute chart here on gold and just zoom back about 3 trading sessions, you can see on this 10-minute chart down below, a couple days ago, we had a big bout of selling in gold. And then just 2 days later, we saw another big bout of selling with high volume. So there's no doubt we are starting to see some big institutions or some big individual investors starting to unload some gold, profit taking in their portfolio, as you just mentioned, Daryl. So this doesn't mean gold's putting in a top yet. It just means we're getting to the point where some big savvy investors are also locking in some gains. They're managing the risk. They're focusing on protecting capital. So this is just an early warning sign that we're in a volatile market condition for gold. Right now, I believe we're entering a very volatile space where there is fear of losing money or fear of giving gains back. So we have people locking in gains like this. And then we also have fear of missing out. So every time gold pushes to a new high, it's triggering people to be like, I can't take it anymore. I have to get in. Everybody's making money in this space but me. And so we're going to have waves of profit taking, of selling. We're going to have waves of people buying and piling in. So just expect a volatile ride. I mean, this is the part a lot of people have been waiting for. We got this big rally in gold, silver, and miners. And it's fun. We need to enjoy it. But we also need to know eventually it will have some type of correction. And the question is, are you mentally prepared? Are your positions prepared? Like, do you have a strategy to lock in gains? Or are you just going to mentally ride it out and anticipate this time is different and hope and pray it doesn't have a bigger correction than what you're comfortable for? So it's kind of where I'm at mentally. Short-term trade, I'm not too far percentage-wise from closing out. Long-term investor, I'm looking for some type of massive blow-off phase where I might actually liquidate some physical metals as well. Yeah, silver's pretty much doing the same thing. It's on fire. It's taking off. I mean, the monthly chart, silver has blown past my Fibonacci targets. So it is kind of going into, if you go back to 2010, 2011, we're going into like parabolic price action here. I do think silver is going to break to all-time highs. I think we're going to have a big blow-off and spike higher. In fact, I was just chatting with another trader. Potentially, silver could spike up to about $84, $85 over the next 4 to 6 weeks potentially. And that would mean gold probably goes to 4,500, potentially even higher. So it just depends if we kick into this real serious feeding frenzy and parabolic move, which you can almost cut the air with a knife of how much FOMO there is and how much people are in love with their precious metals and uranium positions and all of that stuff. Because everybody's accounts should be hitting all-time highs. If it's not, you don't have a very good strategy in play. And so when times are really good like now and everything is popping and running, we do need to know that after good times comes quiet times or tough times, right? So it comes down to understanding we're in this exciting, fun phase where we all feel like heroes and we know what we're doing. The question is, when the music stops, do we know how to remain heroes and maintain or retain our capital, protect it, or potentially grow it when things go sideways or downward? So right now, it's just a feeding frenzy, and you got to be part of the precious metal space and just enjoy the ride. But make sure you've got a strategy to identify, hey, is this price reversing? Because when you look here at 2011, man, it rallied significantly, and 1 month later, it gave back that whole parabolic move, and then it took a long time to recover. So that's what I'm worried about, is we have a big spike straight up. That is going to be the FOMO spike. And then, of course, everybody who's bought in that big green spike ends up paying a premium, and they might not see new highs for a very long time after that. And silver's had much of the same. If we look at silver, this past session, there was a big bout, heavy volume selling in silver as well. So again, it's not just gold. People are trimming profits. It's silver as well. And, it's just a sign that there are some savvy investors protecting their capital. They're not swinging for the fences. They're actually like locking in gains on the way up, which is what I do. It's not about how much can I make. I need to make the most out of this move. I want to catch a good chunk of this move. I also want to protect myself. I don't mind making a lot less than what the asset actually moved, but I don't have to worry about giving it back and all of that later, simply because I was, reaching for the stars.
The financial landscape is entering a decisive turning point. Precious metals continue their steady climb, while the broader equity markets exhibit the same fragile strength observed before previous downturns. Despite the excitement in gold and silver, the deeper reality is that few investors actually hold any meaningful allocation to tangible assets. Institutional advisors, late to recognize the trend, are finally recommending metals, a signal that mainstream sentiment is catching up. Historically, this phase of broad acceptance often marks the late stage of a cycle, where optimism and inflows reach their peak before volatility takes over. Across the charts, the same patterns are emerging: weakening technicals beneath rising prices, fading momentum in major indices, and a dollar showing signs of turning from weakness to strength. The setup mirrors the conditions seen in 2007, where both gold and stocks rallied before a sharp global reset. If that parallel continues, the next phase could bring a significant correction across equities, oil, and risk assets alike. For now, gold and silver may enjoy a final parabolic push, but prudence demands preparation. In every cycle, the fun phase is followed by the reset, and that moment may be closer than most expect. Let's get back to the interview.
Most people don't carry precious metals. Really, us in this space obviously love it, have a heavy weighting to it, but most people in general have very, very, very little amount of precious metals in their portfolio. Typically when everybody starts talking about something and they put all these big targets where they ignored it forever, and now finally it's one of the top performing assets, and now they're all saying you need to hold it. It's like, it's kind of, to me, it's a bit of a warning sign that it's becoming the crowded play. They're really saying it because, it makes them look good. They're getting into it because it's taken off, and they really just follow their herd. If they don't do what investors are doing and other investors are doing that's making money, they look like they're left behind. So you always see like advisors generally late on the train, and you see all that. But you bring up a good point. If all the big investors or the big advisors are now saying get precious metals, is that going to spark a whole new big wave of money rolling into gold and bring in fresh blood? It probably is. That's probably one of the reasons why we're seeing things go up now. It really doesn't matter. The last few days, it's just gold just keeps grinding higher. You can pretty much see and feel the inflows. There's nothing really stopping it right now. It might slow down a bit, but overall it just keeps pushing higher. And that's why you don't want to try and pick a top in this. You can pick targets. I like to pick targets of where we should see things run out of steam, take a pause and a breather, which gold has been doing for the last several years. It just keeps hitting one target after another, lets us analyze and draw the next set of targets. And right now, 4,100 is the next target. And then from there, we'll have to recalibrate and say, okay, well, where should it go next? And for all we know, maybe gold is going to go extreme parabolic, kind of like we saw in the 80s here, where or the late 70s, where it shot up and it rallied like 700%. So there's potential it could go a whole lot higher. If we look at the overall markets, we'll look at the QQQ. This color-coded chart here is based on technical analysis. It's also based on cycles. It's based on market sentiment of market participants, of money flows. And what's interesting is this previous high we saw in the stock market, it had rallied up, we had green bars, and then we got this climb in pricing with really weak underlying technicals and sentiment. And what we have right now with the stock market rally is a very similar situation, again, where the market is rallying, but if you lift the hood to the market to take a look at the engine, it's not very strong. And that's what these red and orange bars are telling us. They're saying, hey, the market's trending up, but just be aware, it could reverse and start to sell off fairly sharply. So if we go back here, Daryl, and look at the 2007 stock market peak here. So the candlestick chart in the background is the S&P 500 hitting all-time highs just before the 55% crash in the financial reset. Gold was also rallying up together, telling us that something is wrong. Big money's flowing into gold. Gold took the lead in terms of performance. Well, if we look on the right-hand side to where we are today, we have the S&P 500 pushing up at all-time highs. We've got gold outperforming and running higher, telling us that something big globally is about to happen, something bad. And so people are moving for protection and getting physical assets. And what's interesting here is if we look at the chart of the dollar in 2007, the dollar fell. It was out of favor. It was one of the most hated currencies. Everybody was saying the dollar was collapsing. Gold's going to the moon. This time is different. Well, if we look at where we are today, it's a very similar situation. We've got the dollar down. It's one of the most hated. Everybody's saying it's going to collapse. This time is different. And reality check, every time is different. But price action does the same thing. It either goes up because they're bullish, people are bullish, or it goes down because they're fearful. And this whole market scenario right now is the fundamentals are different. They're different every cycle. And usually when gold's outperforming and the dollar is down, we're usually going through some huge change. It never ends up being the end of the world. It's just cans get kicked down the road, things recycle. And so people right now are super bullish in metals. They're bearish on the dollar. We're about to see, I think, the stock market do what it did in 2007, which is eventually it's going to start to sell off. And eventually we're going to go into one of these huge 50% corrections. Gold, while it starts to sell off, I think we're going to see gold and silver have one final big push higher, as you and I already touched on. But eventually the yellow line here, gold will pull back with the stock market just because of mass liquidation, margin calls, fear. When people get nervous and they're losing money in most of their assets, they usually liquidate everything, including gold. That's why we see gold and everything sell off. And when the world kind of falls apart, the US dollar in the past has put in substantial rallies and taken off as a defensive play. And I don't know why 100% that is, but I would think it's because the United States is a powerhouse. They control or try to control and rule the world more or less. They got the military, the sophistication to do a lot of that. And so I think that might be why the dollar strengthens. The Western economy bounces back so fast. It's very powerful. And so this is like the scenario that I think we're coming into is a big correction in the stock market. And right now we're in this final exciting, fun phase of small caps and micro caps, precious metal space. All those things are taking off right now. If the dollar, if you get out of stocks, if it starts to fall, you can move into the dollar, which we did actually in 2022. If we go and look at 2022, the stock market fell 22%. And the US dollar rallied like 17%. And I really like the US dollar because even a big pullback within this rally is like percentage-wise, it's really small. I mean, you see like the stock market pull back 3-5% very quickly. Well, a huge multi-week sell-off in a currency is like 3 or 4% in most cases. So it's very controlled, and you get, everything's falling apart. You just move to a currency that currencies can trend very nicely.
And then could we wrap up with oil?
Sure.
Yeah, oil's been volatile.
Yeah, so oil, pretty clearly, it's in a downtrend, a series of lower highs, lower lows. That's the definition of a downtrend. I do think it broke down just last week here, broke down below this 61.50 area. So now it's breaking down. I think we're going to see it down around 56, 58. And then we got to see if it's going to hold that level. I think we could see it eventually break those lows. If we do go into a recession, if things start to stall out here, I think we're going to see oil back down in the mid-20s or 40s. As we know, it can go negative. So any value is possible. But based on this chart, I think we're going to see it get beat up pretty well. And if we get rid of that negative spike, we just come back down to kind of historical price action here. See how far this loads. I think we can come back into this range. If I draw a line right across here, this $42 area is somewhere in this $42 area is a very significant point where it's been resistance. and then support, found major support. We've had a lot of price points tagging through here. And so, of course, if the economy weakens and everything comes to a grinding halt, we could see oil go into a landslide and sell off and go back down to this level. It's amazing how many people say there's no way it's going to go that low. But as you can see in history, it's been this low many, many times. This is actually a normal low, really. It's just people don't think it should be. But when you look at the big picture, you really do get a view of the overall price action of the market. And most people get zoomed in way too much to the intraday charts and the daily chart. Even the weekly chart doesn't give you enough to look at. You really have to zoom back like 15, 20 years just to get a feel of where the upper and lower ranges are for a particular kind of commodity or asset that you're looking at. And so I think oil's going to go for a big haircut here eventually, and we're going to get that financial reset, and it'll be very good for precious metals.
The setup across global markets is reaching a critical juncture. Precious metals remain the heartbeat of honest value, while risk assets show all the classic signs of exhaustion: weak internals, euphoric sentiment, and stretched valuations. Gold and silver continue to attract flows as fear quietly returns beneath the surface of optimism. Yet the broader economy is flashing warnings. Declining liquidity, fragile consumer spending, and political uncertainty are combining into what could be the final calm before the storm. When history rhymes, it does so subtly. The signals appear slow, but the reversals arrive fast. This is the stage where disciplined investors separate from emotional traders. Protecting capital now matters more than chasing the last leg of speculative rallies. Every cycle ends the same way, with crowded trades, overconfidence, and the illusion of safety in overbought markets. Those holding sound assets, real money and tangible value, will navigate the transition better than those relying on paper promises. The next move isn't about predicting the exact day of reversal, it's about positioning for resilience when the turn begins. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.